That's a big claim that he is trying to make there. Can he actually do anything? I don't think he can.
Yeah, it's a dangerous conversation in terms of, but it's not political. But the Federal Reserve controls the front end. They lowered rates in September. The front end of the curve has been sort of stable. They don't control anything past that. You would think, I would hope the president would know, or people in his cabinet, administration, in his circle would know as well. The interest rate market is going higher for a myriad of different reasons. By the way, not least of which some of this policies this administration is looking to implement.
Yeah.
Yeah, boy, this seems like deja vu. I mean, we've had this kind of joust going on before, I think, between the Fed and Donald Trump. And it's interesting. I mean, first of all, I'll say this over and over again. One of the reasons why that little blue book you carry in your back pocket called U.S. Passport is a very special thing is because of our central bank's independence. And I do think that the Fed at least somehow can control inflation, which I think is really depicted on some level through the long end of the curve. But we're at a place here where I think everyone's very aware. Since the Fed started cutting aggressively, this is one of the first times or the few times in history you've had this kind of a sell-off in rates, especially at the long end. And that's really actually what we're talking about. And I would make an argument after some oversold conditions in terms of bonds, so upwards in yields going into that CPI print that we got last Wednesday, I actually think we're still very much in an uptrend. And I think this is something that's going to be a bit of a head-on. This is all happening, by the way, while liquidity seems to be just going everywhere, and a dynamic at least around some of the early round of policy statements and some beginning of some follow-through is none of this is good for the long end of the curve, as we say. So markets are at all-time highs. There is, if you want to just think about, hey, if we can force down rates and if we can force down lower oil prices, this is great for the economy, but it doesn't work like that.
You can argue that maybe he has a little bit of I don't want to say power. I don't want to go that far. But, he could possibly job on oil prices. But in terms of the Treasury market, it's just too big and too deep for him to have that effect. So there could be a difference between just saying that you're going to demand lower interest rates versus I'm going to make them come down, which he stopped short of saying that.
Right, unless he's what he really meant to say was totally talking about the near end of the curve, and I'm going to put as much pressure as I can on Jerome Powell, and so we will see the near end of the curve. But just what you're talking about, that you push on the near end of the curve, and what's going to happen when you go, he doesn't control 10-year rates. He can yell all he wants. He knows this. So part of the reason that he won was to talk about inflation is too high, too high. It hasn't been tamed since November 6th. So, he's wanting to play both sides doesn't make sense.
Yeah, I mean, these guys have covered it. I mean, if the yield on the 10-year goes higher, despite him talking about the Fed funds rate going lower, what is it speaking to? It's speaking to, higher budget deficits, higher inflation expectations and the like. And so really the only thing that Fed funds going lower does, it kind of gives a better chance that inflation gets restoked. And, the other thing is like he's going to have a really cozy relationship with the Saudis. And I know we're going to talk about oil later. They don't want oil to go lower. You know what I mean? So there's a lot of things set in place. If anything that's happened, a lot of things have gone up since November 6th, oil being one of them. It was trading above $80 just recently, and I think over the last year, the average price was probably somewhere around 70, right? So there's a lot of moving parts here, and I think jawboning is really, not the way to achieve the policy goals that you want to kind of see happen for a lot of this kind of legislative priorities that you have and the priorities for the country and changing the direction, and that's one of the reasons why he did get elected.
Yeah, but, some of the policy discussions that are going on and probably have to go on in earnest are tax cuts and really what can happen in terms of extending the 2017 tax cuts. But there's some horse trading going on. And we're reading today about SALT, state and local income tax, and the dynamics that are really important in some blue states, though, who have some pretty strong, I think, senatorial Republican support. And there's an argument that there already are places where some of this is net budget unfriendly. I mean, there's no question about it. So it doesn't mean SALT taxes are going to change the prospect for the Treasury market. I'm just saying that the entirety of all these conversations are ones that don't help. Meanwhile, you also have around the world. I mean, the ECB, I just want to point out, there's a lot of folks in at least in the futures markets are betting on a 50 basis point cut by the ECB sometime soon. So the dynamics here in terms of what central banks are doing and the impact and some of those differentials, I don't know if it's going to help the cause in the U.S. I actually think it could push Treasury rates higher.
We're going to see, I think, February 4th, how the Treasury Department is funding all of this. Mm-hmm. And the front end of the curve is so much deeper, so you can place a lot more money, but more risk.